Well, really nothing's changed recently in the global landscape. We've been facing lower commodity prices now for the best part of a year, and irrespective of the commodity market we look at, the drivers are the same. We've had this big supply increase because there's been a lot of capital investment over the last 5 years, and there does look like there's a bit less demand growth than what we thought, given the weakness probably in Europe and China. And so you put it all together, no matter what commodity you're in, prices are down, and because of that, resource companies are going to be facing probably lower revenue lines than what they thought perhaps even 6 months ago. But in the end, not really much has changed. Whether or not lower oil prices are constructive or not for any group in the global economy really depends where on the fence you sit. Now, when we look, for example, at the US economy, now 68% of its economy is consumption and 1% is oil and gas capex. So in the end, lower oil prices are going to be a massive net benefit for that economy. And that's the same also for Europe and Japan. So overall, we tend to think that if these lower oil prices are sustained, it acts like a tax cut, and it'll boost global GDP by around $600 billion next year, and that would be equivalent to a 0.5% fiscal stimulus. So overall, that's going to be very constructive for the global economy. Where it's probably going to be, a little bit harder to bear, of course, is for energy producers. So particularly in economies where they're very oil dependent, the petrodollars are important not only for growth, but also for funding government spending programs. So that really reflects countries which are members of OPEC, and other parts of the Middle East. So, and broader economies such as Russia. So they're the ones who are probably going to cop this a little bit, whereas for the net oil importers, it's going to be a very significant source of stimulus, and as a result, you would expect some better earnings growth and better economic growth in 2015. Well, in the scheme of things, the US energy revolution has been a massive transformation in global energy markets. And when we look at it, since 2006, America's oil imports have declined by around 9 million barrels per day. And that's equivalent to the energy exports of both Saudi Arabia and Nigeria. So this is quite a big change that we're seeing. And when we actually think about it, OPEC now is engaged in quite a significant game here with non-OPEC producers, because they believe they have lower costs of production, and as a result, they're really trying to hold their market share. Now, if I was OPEC, I really wouldn't be holding my breath to sit there and think that all of these changes we're making with oil prices coming off are really going to take out the US shale gas industry. The shale gas industry efficiencies are improving. At the same time, they've really sold forward 3/4 of their production for next year anyway. And at the same time, the drillers with the shale gas and shale oil can be moved from one location to the next. So in many ways then, OPEC is trying to hit a moving target. And I think they're taking an immense gamble trying to put price pressures on this future US production. Well, what we saw from last week from the European Central Bank President Mario Draghi is he didn't provide the stimulus that markets were looking for. And what the President came out and said is that we want to see how these oil prices impact regional growth and inflation. And they're going to be watching this, I tend to think, in the coming months, as are all regional central banks. So this is probably going to be the predominant theme we see, at least from the, from the monetary authorities around the world for the, in the early part of 2015. Now, I tend to think that the only region which has a risk of deflation being recorded in the following months clearly is Europe. The inflation rate's very low already. It's at 1/4%. And so it probably wouldn't take much to tip that into negative territory. I don't think markets would have an adverse effect about that, and nor would the ECB be worried unless they thought that that was going to become a more permanent dynamic. And if that is the case, to drive that result, you're going to have to see oil prices continue to decline month on month. And I'm just not convinced at this stage that that will be the case. I tend to think there is a floor under the global price. It might be lower than what we have now, but I don't think we're going to see months on months and quarter of falling oil prices. So in the end, if that were to be the case, you'd see some pretty significant stimulus being provided by regional central banks. If it does look like the growth's going to be more constructive, and it probably will be in the US, Europe and Japan because of the free cash flow that lower oil prices give households, but inflationary pressures continue to be down, I tend to think central banks will take that in their stride. I don't think they'd have any knee-jerk reaction. They'd probably be looking at inflation on a core basis, so they remove the impact of food and energy. Now obviously if we get a better economy we can get better earnings growth, but in the end we don't think that even though there's going to be a good pass through to economic growth, it's not going to be a major game changer in 2015.